In this presentation, we will break out the short-term portion of an installment loan, this time having a loan that has both a current and long-term portion within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. You can open the open windows, go into the view tab up top with the view drop down and open windows list. So what we're going to do now is take an adjusting entry looking at an installment loan that has both a long-term and a current portion to it and doing an adjusting entry for it. So we're going to go to the reports up top and go to the company and financial and take a look at the balance sheet standard. So we're going to adjust the balance sheet to customize the report date range. We're going to make that date range 01/01/19 to let's make it 02/28/19, let's say. So that's going to be the dates that we will be working on, January through February 2019. Okay. So we are doing adjusting entries as of the end of February. So this is our cutoff date, as it's often called. We want to make the financials correct as of this date. We're making up all the little trimmings that we have to do if we were to present these financial statements to someone such as a bank or to prepare taxes for them or something like that. Now this is going to be dealing with the loans here. And again, you really want to think about how you're going to do this from a bookkeeping standpoint. Do you want to work with an outside CPA firm? How often do you need to do these types of adjusting entries? Particularly this one, because it does deal with an item where if we look at this loans payable account here, what we want to do is break out the short-term and long-term portion to be correct on an accrual basis, which is helpful to us because it allows us to see how much is due within the next 12 months as opposed to how much is due after that next 12 month. Useful information, not something we typically do as we make loan payments, however, because with an installment loan, we'd have to adjust that each time, and we'd have to have two accounts for each loan. So that's why we typically do this periodically. You could do that periodically by basically having one account and having an accountant or something that would go in there and do this adjusting entry periodically as needed. If we're a smaller company, that would work, or a larger company, we can do it each month. We can break this out. Also note that we could have more than one loan in this loan payable account that we then track through subsidiary accounts in some way, having the loan documentation, having the amortization schedules, or we could have multiple loans that are listed under this one loan payable account and track that information in that format. In our case, we're going to have this one loan payable, which includes two loans in it, and now it's the adjusting entries at the end of the month, and we need to break out the current versus long-term portion. We did so with a smaller loan, which was all current. And now we're going to look at a loan that has a current and long-term portion to it because we pay monthly installments and it's over a year loan. So if we double click on this item, this loan payable, we can see that we have this first one was $22,000 plus the $50 for $72. We're going to say here that that's one loan for our purposes. And then we made two payments on that loan. And then we got another loan that's included in this account for $5,000, but we've already adjusted it out of the account because it's all current. So as far as this point in time, none of it is in this account because it's not long-term but current at this point. So what we're left with is this $69,878, which is this first loan, which is a $72,000 loan for which we made two payments on, giving us a balance at this point in time of $69,878. What we want to do periodically when we adjust these loan accounts then is tie this out to an amortization table. So we made this amortization table in the past. This is what it looked like. So remember, when you see a loan, it's really going to have the loan balance, the number of payments, usually the interest rate, hopefully, and usually the payment amount. That's really what they emphasize here because that's the number that they're trying to see if we can make sure we pay in order to make the payment or sell us on the loan for this $1,359. What we do not often get is an amortization table, and we're going to need it in some way to both make the proper payments and or adjustments at the end. So we made the amortization table in the past. This might be something that you have a CPA firm help to do, And if that's the case, then the simple way to do this would be to say, hey, I'm just going to make these payments and lower the loan amount by the entire payment, the entire principal, whenever we make a payment. So if I go back to our QuickBooks, one method of adjusting loans is to say, I'm not going to decrease it by the principal only, but just by the entire payment to this loan amount, knowing that that's wrong because I'm going to have an interest portion, but not being wrong in the sense that we're going to have it be adjusted periodically, monthly or yearly by the CPA when they do their year-end adjustments, and then tell the CPA, hey, would you make an amortization schedule and then break out the interest versus the principal? The other way we can do that is either make the amortization schedule or ask our CPA to make the amortization schedule, or accountant or someone, whoever, the tax preparer, to help us out with that. And then once we have that, we can make each of our payments breaking out the principal and interest, which is what we have done. So our principal portions were these two amounts. So in other words, we're after the second loan payment. Our balance should be here. This was the beginning balance. We made these two payments of these amounts, but this is the interest should have been allocated to them, and therefore the principal reductions were here. This then is our actual balance as of the point in time, as of February 28th. So going back over here, we're going to say that this is correct, the 1059 and the 1063. So the 69,878 is the correct balance. If we go back here, that's the correct balance that we want to have. So that's the first thing to check. Does the balance check out to what we would think? I mean, if this was a loan as of the beginning of the year, which is kind of what we're assuming in this example, and we made two payments on it as of February, January and February, so we took a loan out at the beginning of the period. We had two payments, January and February. Then the principal balance should be 69,878. That is indeed the case, and that's easiest to see if we have the entire principal balance in one account. However, now the problem is that, well, should it be current or long term? And we could say, well, anything that's going to be paid within 12 months should be current. And this is clearly going to go over 12 months, 1 year. So now our problem is that we're going to pay part of it current and part of it long term. So the confusing thing is here, we might say, well, hey, I'm going to pay from here. This is going to be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you say, well, I'm going to make 12 payments of that. So you would think that the current portion then would be that we're going to pay 1,359 times 12. That should be the current portion. Let's just break out 16,308 out of this. But that's not quite right, because that current portion, if we did that, would be including the interest here that we haven't incurred yet. We haven't incurred that interest. That would be like saying that we're paying the rent. We owe the rent on the building we are using, even though we haven't used the building. That would be like us adding up the rent that we owe on the building for next year. We know we're going to pay it. Why don't we just put it on the books as a liability now? Because even though we've signed a contract for it, we haven't used the building. We haven't incurred the liability yet. And that's the same here. We haven't, this portion of the payment, we haven't incurred yet. We haven't used it. We haven't used the purchasing power. So although we are going to pay this amount, it's not the current portion of the principal, and that would be over here. So the principal is going to be here. So these items, that's going to be the principal. I'm going to highlight that and say that's the principal. So we'd have to add these up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 payments we're going to make. But this is the principal portion of these even payments. And so if we add those up, that's going to add up to 13,109. So I'll put that down here, the principal portion. Well, let's put it up here. We're going to say this equals the sum of these yellow amounts. It's going to highlight those. And that's going to be the short-term portion. Short-term portion. And therefore the long-term portion, I'll center that, is going to be what the balance is minus the short-term portion. Or in other words, it's going to equal the total minus the short-term portion is going to be long-term. And this number should match where we are at We can make it another color. We got a lot of colors here. That should match where we are at after 12 months of payment. So after 12 months we make payments, that's where the balance is going to end up at. So these should match here. That's going to be our long-term balance. So that's how you can kind of read these amortization tables. They can be a little confusing. So what we're going to do then is we're going to make an adjusting entry saying this is what's in long-term right now. We're going to take the short-term out of it, put it into the short-term portion, leaving that left in the long-term portion. So that's what we'll do now. It's going to be great. Going back here to our forms, we can do this a couple different ways. Normally we would do this with a journal entry, which we would find at the company up top. We would go to make journal entry, and we would make it at the end of the month, and we would debit the long-term portion and credit the short-term portion. We'll come back to here and see this, but we'll try to enter these in there with the registers so that we don't have to know debits and credits, and then we'll look at the debits and credits. We will use the journal entries for some of the longer adjusting entries, and adjusting entries really are a place where you want to know the debits and credits. If you don't have a grasp of them, you probably want help to do adjusting entries if and when you need those adjustments made. And that's going to be when you want the financial statements on an accrual basis so that you can present them and or get a better idea of where we stand at a particular time. So I'm going to close this back out. And we're going to go to the registers, where you could go to the banking and use register, and then find that loan payable register that we're looking for the long-term portion. Or I'm going to do it the other way. You can go to lists up top and go to the chart of accounts, and we could go to the long-term liability. Now make sure you're on the long-term one and not the current liability, which we have set up in a prior presentation. So we want the long-term with the 69,878 in it, double-clicking on that, and we get this little register type thing. And so the adjustment we want, like all adjusting entries, are going to be as of the end of the time period. So as of the end of the time period. And then we're going to say that I don't care. I don't know if it's a debit or credit, but I know it needs to go down, because this one needs to go down from 69,878 to, it needs to go down by this 13,109 to 56,770. So it's going to go by the 13,109. So we'll type the 13,109, and the other side then is going to go to the current loan. So we set up this last time. So if we hit the drop down, it's going to go to the current, that's the loan payable current portion right there. That's the one we want. And this is going to be, I'm going to say, adjusting to break out short-term portion of installment loan. And if we have the loan number or something, we may want to put more detail there and give it the loan number or something like that for these adjusting entries, and enter. That leaves us with 59,769, which should be 56,770. Let's go back here. Should be 56,769, so it's $1 off. I'm okay with that. Going back over here, it's 56,770. So it's $1 difference. And that's rounding here, because if I add decimals, there it is. So it's rounding. So that's okay. So we're going to go back over here, and that's our adjustment. So we've done this adjusting entry. Notice it is a journal entry here because QuickBooks doesn't have any other form to drive this transaction. So although we entered into the register, QuickBooks still sees it as a journal entry. There's debits and credits driving all of this, of course. If we double click on the journal, on the general journal, then we see the debits and credits. I'm going to say, don't show me this anymore, please. And once again, I entered it in there as of 2021. So I'm going to change the date to 2019, the dates we're working on. So 2/28/2019 is what we want. So loan payable, debiting 13,109 and crediting loan payable 13,109. I won't get into the why debits and credits, but if you're interested in the debits and credits, and those are kind of like the building blocks, it's really behind all this, then you can go to the journal entries and take a look at what is happening there. So we're going to say save and close. And yeah, I changed the date, so I got to do that. And that changed the date here, so we're good there. And then I'm going to close this back out and close this back out. And now this loan payable now is going down to this 56,770, about dollar difference rounding. And then the other side is going to, and that's because there's two loans involved here. So if I double click on this, there's our 13, and we moved out this loan here. So when there's multiple loans, we're going to have to do some adding and subtracting to make sure we got them all lined up there. And so I'm going to close this out. And then the short-term portion is going to be loan payable current. Has this 18,109. Double clicking on that, we see that's the 13,109 and the 5,000. So if we go back to our amortization schedules, there's the 13,109. The other was the 5,000 there, just the principal, not the added interest, because we're going to deal with that in a future presentation, which will be great. For more accounting information and accounting courses, visit our website at accountinginstruction.info.